Well, though regulators moved decisively to stabilize the banking system after the collapse of Silicon Valley Bank, much of the fallout remains to be seen. So what does the future look like for the regional bank, and what will become of its assets? We want to bring in Gallatin Group principal John Popeo. He has spent a decade in various roles at the Federal Reserve Bank of Boston and also the FDIC. John, it's good to see you here. There is certainly a lot to unpack, and you're the perfect person to ask because you led deals to sell and also unwind more than 40 failing banks during the financial crisis during 2008. So walk us through, take us behind the scenes, the types of conversations that are going on right now.
Absolutely. So I think the failure of Silicon Valley Bank caught many people off guard, although we were well aware of and I speak only my views. I don't certainly represent any federal agency, but I think that they were aware of interest rate sensitivity and duration risk. But the challenges confronting the resolution were certainly accelerated by the Fed's rate hikes. The very quick rate hikes. I think the Fed had raised rates quicker than any time in history, which was somewhat unprecedented. But behind the scenes, they're likely exploring different resolution structures. And what that means is the assets and liabilities. So if I were to take you back through a typical resolution structure, upon bank failure, the FDIC is appointed as receiver and takes all assets and liabilities of that institution. The FDIC has a number of resolution mechanisms at its disposal. The resolution mechanism that's been selected here is to deploy a bridge bank, which means that the FDIC has approached the Office of the Comptroller of the Currency, a sister regulator responsible for regulating national banks and federal savings associations, to charter effectively a separate bank to assume certain assets and liabilities that are held by the receivership estate. And what they'll do is they'll transmit those assets and liabilities to the bridge bank, enabling something of a good bank, bad bank scenario. And this was actually deployed a few times previously in the 2008-2009 financial crisis. I had the opportunity to work on two of them. But what will be done from here is certainly bidders can either bid on the bank completely, or they can buy certain assets and liabilities from either the receivership estate as well as the bridge bank. And this enables the FDIC as receiver to have great flexibility going forward in terms of disposing of the assets and liabilities and conducting an orderly wind down.
John, why were they unable to find a buyer for SVP?
It's my understanding that they were soliciting bids yesterday. They received several bids. The reason that I suspect that many of those bids did not go through successfully is due to something called the least cost test. And the least cost test is a statutory obligation that the FDIC has to resolve an institution in a method that's least costly to the deposit insurance fund, so as not to expend more from the FDIC Deposit Insurance Fund, which is a fund that the FDIC maintains to resolve failed banks. And they actually raise money for the fund through FDIC deposit insurance assessments on the industry and commercial banks. I suspect that the bids that were received did not comply fully with the least cost test that the FDIC is bound by, which prompted them to engage in the systemic risk exception, which we saw announced yesterday evening, and effectively backstop insured and uninsured deposits for the benefit of depositors and the financial services industry.
John, what do you make of how this compares to what we saw during 2008 in the financial crisis? There's been some comparisons. Bill Ackman was bringing up what happened with JP Morgan after it bailed out Bear Stearns. He doesn't see another bank stepping in to help Silicon Valley Bank. This was last week. Is that a fair comparison, or how are you viewing this action from regulators this time around?
You know, this happened so quickly, and it was precipitated in large part by rate hikes, aggressive rate hikes to quell inflation, understandable. But I view this as very different from 2008 and 2009. And many of the resolutions that I had the opportunity to lead many of those were actually capital failures, and they took place over the course of several months where the FDIC had appropriate time to line up what would be an acquiring institution to purchase certain assets and liabilities from the receiver. And that was done well in advance of the institution falling into receivership. Here, what we saw was something of a liquidity crisis and really just a classic bank run. And that is a little bit different than what we saw in the last crisis, where I think we had a bank run in IndyMac, which ultimately led to a conservatorship. But there are very few others that come to mind.
All right, going to have to leave it there. John Popeo, really appreciate all that. Thanks so much.